Most people think dividend investing is simple. Buy stocks, collect passive income, retire early. And on the surface, that sounds amazing. But there's a problem almost nobody talks about. Sometimes, the portfolios that look safest in the beginning become the weakest later on. Because a lot of investors become obsessed with one thing: high dividend yield. They see a stock paying 9%, 10%, maybe even 12%, and immediately think, that's freedom. More monthly income, more cash flow, faster retirement. But what many people discover too late is this: a huge dividend means nothing if the portfolio itself slowly falls apart underneath it. And that changes everything.
The trap most income investors fall into. Imagine two investors. The first investor builds a portfolio focused entirely on high-yield assets. The income looks incredible immediately. Every month feels rewarding. Cash flow starts arriving fast. The portfolio appears to be working. Meanwhile, the second investor builds something slower, lower yield, more diversified, focused on dividend growth and long-term appreciation instead of maximum income right now. At first, the second portfolio looks boring. Less income, less excitement, less emotional payoff. But fast forward 10 or 15 years, suddenly the second investor's income has grown dramatically. The portfolio itself became larger. The dividends increased. Inflation had less impact, and the overall system became stronger with time instead of weaker. That's the difference between extracting income and building a portfolio designed to survive decades.
Why high yield can quietly become dangerous. Here's something most beginners don't realize. A stock's dividend yield often rises because the stock price is falling. That means sometimes a 10% yield isn't a sign of strength. It's a warning sign. Maybe the business is struggling. Maybe debt is increasing. Maybe profits are shrinking. Maybe the dividend itself is unsustainable. But emotionally, investors ignore the risk because the income number looks so attractive. And this creates one of the biggest traps in dividend investing: chasing income today at the expense of stability tomorrow. History is filled with examples of companies that looked like amazing income machines right before cutting their dividends. And when that happens, investors often suffer twice. The income drops, and the portfolio value drops too. That combination can destroy retirement plans faster than people expect.
The real goal isn't yield. This is the mindset shift experienced investors eventually make. The goal is not, what pays me the most right now? The real question becomes, what can continue paying me 10, 20, or 30 years from now? That changes portfolio construction completely. Instead of only maximizing yield, smart investors often focus on 4 things at the same time: reliable income, dividend growth, portfolio stability, and long-term purchasing power. Because income that never grows slowly loses value every single year thanks to inflation. And that's the hidden danger most people underestimate.
The power of dividend growth. This is where dividend growth investing becomes so powerful. Instead of chasing the highest paying assets available today, investors focus on businesses capable of increasing payouts consistently over time. At first, the income might look smaller, but over long periods, growing dividends can become incredibly powerful. Because eventually, your income stream starts compounding too. That's when the portfolio begins feeling less like an account and more like a financial system, quietly supporting your life. The math people rarely think about. Let's make this simple. Imagine someone builds a portfolio generating extremely high income today. Sounds amazing, emotionally. But if the income stays flat while inflation rises year after year, eventually that cash flow loses buying power. Now, compare that to a portfolio with lower starting income, but consistent growth underneath it. Over time, the income grows, the portfolio value grows, and flexibility grows too. Eventually, the second investor may end up with larger income, stronger assets, and better long-term security. Not because they chased more yield, but because they gave growth enough time to work.
Why selling shares isn't automatically bad. This is another uncomfortable truth in dividend investing. A lot of people believe never sell shares, and emotionally, that idea feels safe. But many financially successful retirees don't live only off dividends. They live off something much bigger: total return. That means dividends, portfolio growth, and strategic withdrawals working together. And ironically, diversified portfolios built around total return often become more sustainable than portfolios aggressively chasing income alone. Because the objective isn't preserving every share forever. The objective is building a portfolio capable of supporting your life long term. Financial freedom usually arrives slowly. This is the part nobody tells beginners. Financial freedom rarely appears overnight. Usually, it arrives one expense at a time. First, your portfolio covers small bills, then groceries, then utilities, then maybe part of your rent or mortgage. And gradually, life feels less financially stressful. You gain breathing room, flexibility, options. That's the real power of investing. Not just replacing your paycheck, but reducing the amount of your life controlled by money.
What a healthy dividend portfolio often looks like. Ironically, strong long-term dividend portfolios are usually less exciting than people imagine. Not flashy, not filled with risky 12% yields, just balanced. A mix of dividend growth, broad market exposure, stability, and moderate income. Because experienced investors eventually realize something important. The portfolio still needs to grow even after retirement begins, especially if that retirement could last 20 or 30 years. That's why survivability matters more than excitement.
Final thought. At first, investing feels like chasing numbers. More shares, more income, more returns. But eventually, the deeper goal becomes clear. It was never just about dividends. It was about freedom. The freedom to work less, stress less, help your family, survive uncertainty more comfortably, and take back control of your time. And ironically, that freedom often comes faster when your portfolio keeps growing underneath the income, instead of being pushed too hard too early. Because the strongest portfolios are not built for this month. They're built to survive decades.